on the U.S. markets, we're now joined by Bill Strazzullo, partner and chief market strategist at Bell Curve Trading. Bill, thanks for joining us tonight. Now, Bill, all along, Wall Street seemed relatively confident that an 11th hour agreement would end this impasse. The Dow, in fact, has risen since October 1st. That's the first day of the partial government shutdown and the de facto kickoff to the countdown towards the October 17th debt ceiling deadline. So, Bill, did Wall Street get it right? And what does this news mean for Wall Street going forward now?
Yeah, I think the consensus was correct in this case that finally a deal would be approved. Look, today was a very solid day in the U.S. stock market. Dow Jones up 205 points, NASDAQ comp up 45 points, S&P 500 up 23 points. But people watching the show should realize that this was really a relief rally, relief that this debt ceiling impasse finally, it looks like, is going to be behind us in a couple of hours. For people who are not familiar with the debt ceiling, because even for people in the markets, it's a relatively new phenomenon. We didn't talk about this 3, 4, 5 years ago. But it would have been catastrophic to put the U.S. government in a position where it could not fulfill some or all of its financial obligations. I mean, we just dodged a major bullet here. And so it's not surprising.
But we only dodged it for now, Bill. Bill, it's only a very temporary dodge. I mean, the deal funds the government until January 15th, and it only raises the debt limit until February 7th. So we've really just kicked the can down the road. Shouldn't there still be some market concern over the bigger picture here?
I think there will be when you look at, remember, we haven't seen any economic data now for probably about a week or so. I think what you're going to see going forward, that the government shutdown and this whole debate about the debt ceiling is probably going to take, you know, as much as 0.5% off fourth quarter GDP. I mean, we've already got an economy that's laboring, that's struggling. The last thing we needed was a contrived crisis that was going to make the economy even weaker. So I think once we start to see the impact of this, you know, people realize that we're going to be back in the same boat the beginning of February, then, you know, I think this rally is really going to be short-lived. I mean, our feeling is that the upside in the S&P 500 is probably about 1750, 1770. Maybe you follow through a couple percent to the upside, but that's basically where we're telling our clients that we want to get off the train and start to reduce our U.S. equity exposure. So I do believe that what you've seen here is going to be short-lived.
But, Bill, is part of this rally, short-lived as it may be, due to the markets feeling strongly that in light of this, the Fed may now be more reluctant to start tapering down the stimulus?
Yeah, that's actually the flip side. I think in addition to the relief about the debt ceiling impasse being behind us, the other thing that's driven the markets higher is the fact that the tapering is going to be pushed off. I mean, I don't think you're going to see the Fed reduce the quantitative easing or money printing, certainly not anytime this year. And I think there's a good chance it gets pushed out to the end of the first quarter of next year, maybe even the end of the second quarter. So that's one positive for the equity markets that's going to come out of this whole fiasco, is that the tapering or the reduction of quantitative easing is going to get pushed out at least one quarter, probably two.
Okay, Bill, one of the things that have been lost in the headlines is corporate earnings. We had a lot of earnings coming out, and they've kind of not been the focus. Let's talk a little bit about financials. We had Bank of America come out with earnings today. It's done well. What's your view on the financial sector?
I think the financials are going to be fine going forward. I do think when you look at this earnings period, when the companies start to talk about their forward guidance, you're going to hear a lot of similar messages, in the sense that there's concern about you know, what we just saw took place with the government shutdown, that there's still a large amount of uncertainty because we're going to have to deal with this whole problem again the beginning of February. So I think the earnings themselves will be okay, but I think what's going to be of concern is when companies start to give you their forward guidance, and I think that you're going to hear a lot of similar messages in terms of the uncertainty in Washington being a problem for large corporations going forward.
So uncertainty, the key word of the day, and the key word going forward. We're going to have to leave it there. Thank you so much. Bill Strazzullo, partner and chief market strategist at Bell Curve Trading.